So joining me here on What Investment, we have Richard Manley, CEO of Seneca. Richard, thanks very much.
Rory, no problem at all. Nice to see you.
Cheers. An enterprise investment scheme, what do investors need to know?
Yeah, Rory, so the Enterprise Investment Scheme was a scheme established by the UK government to really incentivise the UK investment community to invest in sort of young, growing businesses, those SME businesses in the UK economy. These young businesses are kind of backbone of the UK economy, so through the tax incentives that the government provide to incentivise investors to put their money to work in that area, they're sort of driving the flow of capital in to support those young, growing businesses. So there's an array of tax reliefs, but really it's about supporting those young, growing businesses under the rules, by example. The qualifying businesses for EIS need to be less than 7 years old. So you can see through that rule alone, you're targeting these young and more immature businesses who need support and capital to help them grow. So the Enterprise Investment Scheme is a set of rules to really incentivise people to put money to work in that area. In, I guess, traditionally, what would be considered a slightly higher risk investment area, because you've got those younger businesses in that area, that's the reason the government give the tax relief as an incentive to compensate for some of the risks. So that's what the scheme does, and I think most people in the market would say it works pretty well. It does a good job of mobilising capital from the high net worth community to put and getting it to work in that SME community.
And how does it differ from a similar vehicle, a VCT?
Yeah, there's a number of differences, a lot of similarities as well. People tend to bash them together. VCT and EIS often are interchangeable words in the IFA community, but they are different. Some of the key differences are around the tax reliefs. So as you'll know, EIS and VCT both have sort of attractive sets and suite of tax reliefs available. But by example, an investment in a VCT wouldn't qualify for carryback relief. So to do with the year in which the investors can obtain their 30% income tax relief on their initial investment, it's different. So you can carry it back under an EIS investment, but you can't carry it back under a VCT. Another good example is EIS investments can qualify for business relief, so they can fall zero rated for inheritance tax purposes. And again, a VCT doesn't benefit from that. Other rules which may be interesting differences are around perhaps the minimum investment period. For EIS investments, you need to hold the shares, or an investor needs to hold the shares for a minimum of 3 years to keep those sort of generous tax reliefs which are available. But for a VCT investor, to keep their sort of initial tax reliefs of 30%, for example, needs to hold the investment for 5 years. So you can sort of see some differences in the tax relief regime between VCT and EIS. But I think it's important one question I get asked quite a lot is, well, the EIS seems more flexible. There's carryback, there's business property relief, there's also loss relief if things didn't go to plan. So why might I consider a VCT investment is a question I get asked quite a lot. And I think there are differences, but then the VCT is worth considering some of the mechanics, the operational mechanics and benefits there. So for instance, in an EIS investment, if you're running a spread of investments, you might end up with 4, 5 or 6 different investments. So 4, 5 or 6 different sets of paperwork, by example. You need to wait for those investments to be made. In the VCT, you can drop your money into the VCT in one lot, if that's what you want to do, or spread perhaps with 2 VCTs, 1 set of paperwork or 2 sets, compared to 5 or 6 bits of paper that take a long time to come. Also with the VCT, you know the date in which you're investing, you know when the tax relief is going to be secured. With the EIS, it may take a little while for managers to deploy the capital. So you can sort of see some of the differences there. With the VCT, another interesting difference is obviously you're buying into a fund, and that fund has existing investment positions. So you know what you're buying into. You're buying into a sort of a legacy set of investments that you might have looked at and think, yeah, these are really exciting. So you can do that with a VCT. You can choose where you want to invest. But with an EIS, you don't necessarily know which EIS investment you're going to get. From Seneca's perspective, it very much depends on what our deal flow is as to which investments our EIS investors will be given. But for the VCT, they can just look at the latest set of accounts, which is all publicly available because it's a public vehicle, and they can determine, yeah, I really like these exciting set of investments, I'll invest in the VCT. So that swings it back towards the VCT. That's perhaps increased diversification. The VCTs often have more investments than the EIS, so you might have 10, 15, 20 investments for that increased spread. And you've got those sort of perhaps operational benefits of security of tax relief at the point you invest, and knowing what you're getting into. So for me, I think it's a balance. There's great tax incentives across EIS and VCT. I feel EIS is probably more flexible on the tax relief side of it, but in reality, the VCT does offer perhaps some operational benefits.
How does the loss relief element work in this scheme?
Yeah, the loss relief is a really important part of it actually when you're considering EIS and VCTs together. As you rightly said, the EIS investments come with the benefit of further loss relief. So what happens very simply is when you invest, let's say, £1 into an EIS investment, the net cost of that pound is reduced by the income tax relief under EIS to 70p, with the 30p being that initial tax relief. If that investment entirely failed, so your £1 investment with a net cost of 70 actually turns into zero, obviously firstly, manager's not done a particularly good job, but then secondly, you want to be able to access this income tax, further loss relief you speak about. And how it works is that 70p, that net remaining cost, can be offset against your income tax bill in the year of the loss. So for high rate taxpayers, that's almost another 30p, sort of 40 or 45% of the 70 can be claimed through income tax relief. So you're sort of saving another 28, 30p in the pound on that 70 net investment. So from an EIS investor's perspective, what they need to consider is what's their capital at risk. Sure. So the risk capital, well, it's not £1 because they've got 30p back, and it's not 70 because if the 70 goes to zero, actually get another circa 30p back through income tax loss relief. So you see, it's quite a powerful relief to incentivise and mobilise the investors to actually back these young growing businesses.
Yeah, and I know a lot of what investment readers will be keen to know about the capital gains deferral. Could you explain that in a bit more detail?
Yeah, I mean, there's a host of tax reliefs and capital gains. It is a key one, as you say. So in an EIS investment, you can actually say you can defer your capital gain. So if you're sitting, let's say somebody's sitting with perhaps a capital gain of £100,000, current capital gains tax rates 20% or 28% on certain asset classes. If they invest that £100,000 gain into an EIS investment, actually you can defer payments of their CGT liability, which might have been £20,000 or £28,000. Now it's not gone entirely, it's deferred. So in the word deferred, it means it will fall back into charge at some point in the future. So when the EIS investment is exited, that taxable or chargeable gain, a capital gain that they reduce rate tax on, will then become chargeable, but very powerful from a cash flow perspective. You think about that pound we talked about a second ago, that pound, 30p income tax relief on the way in, and there's also a capital gains tax deferral. That might be another 20 or 28p from a cash flow perspective that might have to fund. So from a cash perspective, there might be sort of saving 50p or even 58p if it's a sort of a higher rate capital asset that they get taxed on in terms of the tax they would have had to pay without investment in the EIS versus with the EIS investment. It's very powerful to reduce that net cash cost of the investment.
And going back to Seneca more broadly, how long has the EIS fund been operating for, and what prompted you to start an AIM-only EIS fund?
Yeah, so originally Seneca moved into EIS. It's a sort of core of what we do. So when we sort of launched Seneca 2011 time, we were very quickly into EIS. It just made perfect sense to us. We don't sort of create an investment product necessarily to fit the tax relief. We are, as a business, we are backers of the SME community is what we do. If the tax reliefs weren't here, we would still invest in those businesses through different channels. We'd raise money, we'd do it differently. Obviously, if you can invest in a tax efficient way, it makes sense to do it. So early in our evolution, it made sense to access the investments we wanted to do anyway, and we would have done. We may as well do them under the Enterprise Investment Scheme to give investors that tax relief. So we've been investing since inception, 2011, 2012 time in EIS, initially through deal-by-deal scenarios, and then we moved on and created funds, and more latterly our Seneca EIS portfolio fund. And then, as you rightly say, we looked at the sort of performance, and all the way through, we've always invested in private companies, and we've invested on the AIM market. So we've always sort of done 50-50 of our EIS money in the two areas. And more recently, there's been some real interest from our investor base in the AIM elements of our investment strategy. So that is what brought to the second part of your question. That's what's brought us to launch our AIM-only EIS investment fund, really responding to the demand from our investors, who some investors and some of their advisors prefer and like that sort of public market exposure achieved through AIM. So absolutely, we continue to see great opportunities in the private space, but also some fantastic opportunities in AIM. And some investors would just prefer, for their own reasons, to just play on AIM and invest on AIM. So that's a sort of our response to that market position, to create that product that allows them to just invest solely on AIM and the benefits it has.
And is there something about the AIM market at the moment that's particularly exciting?
I think so. I think we've seen, particularly over the last 2 years, COVID's been a really interesting time, the sort of post-COVID period. You've seen some real buoyancy in certain sectors, particularly on the AIM market. Life sciences, biotech, medtech, these sort of areas have seen some real boost in interest in the companies, and consequently that's translated into an increase in share prices of a lot of sort of biotech and medtech spaces. But yeah, generally AIM, it's fairly buoyant at the moment. We've been investing on AIM for sort of 9-10 years now. I'd certainly say that now there's increased deal flow. If you look back over the last 12-18 months, there's increased deal flow. There's increased funds looking for deals. And I think then the broker community, of course, they respond to that increased flow of money because they've got good businesses in their sort of portfolios and client bases. They want to bring them to the market. So it balances the ecosystem. Managers like Seneca, we raise the capital, and the brokers and the advisors know that there's capital there to support these businesses if they want to come onto AIM. So it's a really dynamic and well-balanced ecosystem right now. There's good deal flow. It's in good shape.
You mentioned biotech, but across both funds, what sort of sectors and areas are looking quite good for next year and beyond?
Yeah, I mean, there's a number. We're Seneca are generalist investors, so what we don't want to do is rule ourselves out of certain really exciting investments just because we've got a predetermined investment strategy. We sort of say to our investors and the advisors that work with us that we will judge investment opportunity on its merits. But in terms of exciting sectors, I mentioned medtech and biotech a few moments ago. Certainly a lot of interest in those sectors right now. And then generally, technology and technology-enabled businesses are always going to be a very interesting area. You can get high growth, you can get high returns on your capital invested in those areas if those businesses succeed. So yeah, I think technology, software, and then medtech, life sciences are some really interesting areas right now.
And some of the holdings that have done quite well over since the onset of the pandemic, what are some of the big success stories in the funds?
Yeah, there's been a number. We've got a number of investments in life science, biotech businesses. So we've got an investment in a company called Polarium, who are progressing it's actually a lung imaging technology. So the use of imaging technology with a gas. So the patient will inhale gas, and then they'll take an imaging of their lungs with the gas inside of them, and it creates a much more useful, high definition image of the lungs. So particularly with COVID, you can imagine there's some interest in their solutions, given COVID affects the lungs principally. But obviously, their solution works much more widely. There's been some really good interest in that business over the last 12-18 months and their technology. So yeah, for looking forward, it's quite an exciting business in terms of the differences they can make, both from a financial perspective, but also in human capacity, if they can sort of bring forward new technology to help sufferers of asthma and other lung diseases, if they can improve the diagnosis or treatment for those individuals, then it's fantastic. Investors can feel they played a part in supporting the growth of a business that's created jobs and also help the wider society through implementing their technology and making it available more.
And we get to that time of year where outlooks are coming out. What do you think investors should really be looking out for next year, and what do you think we should expect for the coming 12 months?
Yeah, Senator, we're
crystal ball.
Yeah, we're principally a tax efficient manager. That's what we do. It's the core of what we do. Of course, we've got a much more diverse business. But if you look at the tax efficient space, then absolutely, with the squeeze on, I think, tax reliefs that are available more generally for the high net worths and the higher earners, I think they will more and more have to look at more interesting places to achieve those tax reliefs. So for me, the outlook, I think the tax efficient space is here to stay. It serves a great purpose. I think because of the rules attached to investing in that area, you will see a lot of money going into tech, life science, some of the areas we've touched on already, technology-enabled businesses, e-commerce. So I think all those areas are set for really good growth, supported by some of the capital that EIS can bring. And of course, COVID's brought about wholesale changes or accelerated, probably more to the point, the change in the economy in terms of online retail step forward, people anticipating a step forward 5 years in some cases. So you've seen this step change. So I think next year you're going to see the continued success and growth of businesses who are benefiting from some of the changes in consumer habit brought about by COVID. That's just going to be a continuation of a theme. We've already seen it. We know where it's heading. So I think our job as a manager is to go and identify those exciting businesses who are particularly well placed to sort of benefit the most from some of the changes in investment patterns and consumer behaviour brought about by COVID.
Richard, that's great. Thanks.
Good stuff, Rory.
Thank you.